Hey guys, Chris from Appropriation here, and in this video, I'm going to show you the solution for question 1 from the Jan 2009 PoA Paper 2. If you want to see the solutions for the other questions on this paper, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. And with that said, let's get into the question. Okay, so we have an ever popular partnership question. And they start off by telling us the following information has been extracted from the books of Alert and Wildman, who have been in partnership as manufacturers for several years. Okay, so they start us off by giving us the partners' capital balances as at Jan 1, 2008. Alert has 120,000 worth of capital, Wildman has 80,000 worth of capital. Moving down to the partners' current accounts now, balances at the start of the year, Jan 1, 2008. Alert has a 5,000 balance, but Wildman has a balance in brackets of 300. What does that mean? It implies a negative balance. And on a current account, that implies a debit balance. It implies a deficit on the current account. Okay, let's check out the next piece of information, which is the partner's drawings for the year ended December 31st to 8. Alert took out 7,000, Wildman took out 4,800. And the other piece of information they give us here is the net profit for the year ended December 31st to 8, 72,500. We also have some information regarding the partnership agreement between Alert and Wildman. The first item up is the partners are to receive interest at a rate of 10% per annum on their opening capital account balances. So that's interest on capital. Next up, we have some information regarding the interest on drawings. Interest at a rate of 5% per annum is to be paid on partners' drawings during the year. Okay. Thirdly, we have some information. Wildman is to receive a partnership salary of $1,000 per month. Okay, per month. Remember, that's a monthly figure. All right, and the last bit of information they give us here is the balance of the net profit or loss is to be shared between partners in proportion to their capital account balances. Oh, okay. So the first thing they want us to do is an appropriation account. Actually, I'll show you that here. See, it says to prepare the profit and loss appropriation account for the year ended December 31st to 8 for 8 marks. So before we get into it, if you need to see examples of how to do a partnership appropriation account, I'm going to put a card up there and a link in the description below to my partnership appropriation account video. And it deals with many of the details, all of the details regarding the appropriation account, especially that profit share ratio thing. See how they told us in the previous part of the information that it was the profits are to be shared in the ratio of the partner's capital account balances. I even deal with that there. So if you want to take a look at that video and then come back here, that's fine. If you want to continue with this video, well, let's take a look at the appropriation account. So don't forget to head up, right? Name of the partnership, name of the statement, and the period to which it applies. So FYE stands for the year ended December 31st, 2008. Now, the first thing we're going to put into the appropriation account is the net profit for the year, which is $72,500. Following that, we are going to add any interest on drawings. So let's go up to the partner's drawings balances. And we're going to see that Alert had 7,000 and Wildman had 4,800. Now, the interest rate on drawings was given to us below here at 5% per annum. So all we have to do is find 5% of those balances. 5% of 7,000 is 350. 5% of 4,800 is 240. We're going to add those two together to get 590. And we're going to add that figure to the profit before appropriation. And we're going to get a new figure to be appropriated of 73,090. Now we could subtract the appropriations. Let's start with the interest on capital. So going up to the information on the partner's capital balances, we have Alert has a balance of 120,000. Wildman has a balance of 80,000. Now what is the interest rate on the partner's capital balances? So that is 10% per annum. So all we have to do is multiply 10% by 120 for Alert, 10% by 80 for Wildman, and we're going to get a subtotal there of 20,000. Now, what about salaries? That was item 3 in the information. Remember, it said Wildman is to receive a partnership salary of $1,000 per month. So if we are doing an appropriation account for the year ended 31st December 2008, and Wildman is receiving a salary of $1,000 per month, that means for the entire year, Wildman would have gotten a salary of $12,000. That's $1,000 by 12 months for the year. So we only have those two appropriations. Alert didn't get a salary. 20 and 12 will give us a total appropriation of 32, which we will then subtract from this figure of 73,090 up here. And that's going to give us a profit after appropriation of 41,090, which we will then share. So share residual profit or share remaining profit. Now, let's go to that line that tells us how to share the profit. It says to be shared between partners in proportion to their capital account balances. So we're going to go up to the partner's capital account balance information. So we have Alert having 120,000, Wildman having 80. So basically it's a 120 to 80 ratio, or if you break it down, that looks like a 3-to-2 ratio. Now, the other way to do it, well, the better way to do it, I guess you could say, is you're going to add these two balances together. 120 plus 80 is 200. And then you're going to put each figure individually over that 200. So the 200 almost comes like a common denominator. So Alert is going to get 120 out of 200 multiplied by that 41,090. So you see it there, right? 120 out of 200 multiplied by 41,090. And Wildman will get 80 out of 200 by the 41,090. So you're seeing the two profit figures there, two profit shares there. When you add them up, you get back the 41,090, and that, of course, will leave us with nothing in the appropriation account because we've shared all the profit. Okay, that's it for part A of the question. Let's take a look at part B, where they asked us to do some current accounts. All right, so I've put the current accounts in T account format here. And we have a column each for Alert and Wildman on the debit side and the credit side. The first thing we're going to start off with is the balances in the current accounts. But before we get into it, if you need to get a refresher or see how to do current accounts for partnerships, I'm going to put a card up there and a link in the description below. So be sure to check it out if you need to. But I am going to explain what goes where in the current account in this video, so you can stick around for that as well. So the first thing that's going to go in is the balances, right? So Alert had a balance of 5,000. Now, the current account balance is a credit balance because it records the earnings and withdrawals of the partners. So if it has a positive balance, as Alert has here, that's going to be, well, this is going to be on the credit side, right? So you're going to see a balance on the credit side under Alert's column saying 5,000. But if you remember, Wildman had brackets around the balance, the opening balance of 300, which implies a negative balance or a deficit on the current account. Remember, we said the current account records earnings and withdrawals. If you have more earnings than withdrawals, you'll have a surplus on your current account, hence a credit balance like Alert. If you have more withdrawals than earnings, you're going to have a deficit on your current account or a negative balance, as shown by the debit balance on the Wildman's column. So on the debit side here, you're going to see on the Wildman's column, $300. Okay, now what goes in the current account? We said earnings and withdrawals. What are the partners' earnings? Basically, everything in the appropriation account except the interest on drawings. That's a withdrawal. So you're going to see the interest on capital. You're also going to see the salary for Wildman. We're also going to put in the share of profits. Now, like I said, the withdrawals have to do with drawings and interest on drawings. So the partners' drawings were 7,000 and 4,800 respectively. And we're simply going to find 5%. I mean, we already found it in the appropriation account, sorry. So we're going to plug those in there as well. Now, all we have to do is balance off the current accounts. How do we do that? We add up the figures under each partner's column. So like here, add up these figures, you're going to get $49,004. This is going to give us $7,350. So you're going to find the difference. You're going to subtract the total on this side from the total on that side, and that's going to give you the balance to go here. And the same thing will happen for Wildman. You're going to add up Wildman's credit column, and that's going to give us $72,872. And you're going to add up here, and that's going to give us $5,340. And you're going to subtract, right? So, of course, when you subtract, you're going to get the balances carried down there. Now, if you were to add up the columns on both sides, you're going to see the total for Alert's debit column is equal to the total for Alert's credit column, and the same thing for Wildman. And of course, don't forget to bring down your balance on the credit side. And it looks like each partner has a surplus on their current account, as they had more earnings, more credits than withdrawals, debits. Okay, so we have part C and part D to do. Let's take a look at part C now. Okay, so part C is telling us to state one disadvantage of being a general partner in a partnership. So some of you will be like, well, what's a general partner? Okay, so a general partner is, well, let me just pull up the answer. So you see here, one disadvantage of being a general partner in a partnership is that you have unlimited liability. And that's what a general partner is. Partners in a partnership. Now, normally we consider a partnership to be an unlimited liability entity, and that the liability of the owners, the partners, is unlimited in the event of the liquidation of the partnership. That is to say, if the partnership is closing down, selling off its assets to pay off its liabilities, if the resources of the partnership, when they liquidate them, if when you sell off your assets, you do not have enough money to pay back your creditors or your liabilities, guess what? The owners, the partners, their personal assets may have to be sold in order to honor, or satisfy, or pay off the obligations, the liabilities that the partnership itself couldn't. Right? So being a general partner means that you have unlimited liability. And it means that you can also be a limited partner. Hold on, let me rephrase that. Sorry, I think I said that to make it sound like being a general partner means you can also be a limited partner. No, you can either be a general partner or a limited partner. The general partner has unlimited liability. The limited partner has limited liability. Okay? So I just basically give the rest of the explanation that I said here. So that is to say, in the event of the partnership dissolving, your personal assets, the general partner's personal assets, are at stake of being sold if the assets of the partnership are insufficient to satisfy its obligations, pay off its liabilities. Okay, we have one more part of this question. Let's take a look at it. Okay, so part D is telling us to calculate the amount of the net profit due to each partner based on the principles of the Partnership Act of 1890. If you were taught what the Partnership Act of 1890 is in school, let me know in the comment section below. If you weren't, also let me know in the comment section below. I'm curious, right? I was taught this back when I was in Form 6, I believe. I don't even know if I saw it in Form 5, but I could be wrong because that was quite some time ago. Anyhow, so basically what the Partnership Act of 1890 says, it says that in the event that there is no partnership agreement, there is no interest on drawings, no interest on capital, no salaries awarded to partners, and all profits and losses are shared equally. There's something else about if a partner contributes in excess or more than the required capital amount, the extra amount is treated as a loan and they're entitled to 5% interest on that extra capital contribution. But again, I don't think that's relevant in this case. So what they're saying here is they basically want us to show what happens to the net profit of $72,500 for Win and Bain. So remember, they had a net profit of $72,500. Under the Partnership Act of 1890, if we assume there's no partnership agreement, partners get no interest on capital, no salary, no interest on drawings, and the profits and losses are shared equally. So all we really have to do is divide this by 2, and guess what? We'll get an equal share for Win and Bain, share of profit due to each partner, $36,250, which of course is exactly half of $17,500. And that's it for this question. Okay guys, so there you have it. That's the solution for question 1 from the Jan 2009 POA Paper 2. If you have any questions about it, please feel free to leave it in the comment section below and I'll get back to you when I have a chance. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe and be sure to check out my website where you'll find some pretty useful POA handouts. Anyway guys, as per usual, thank you so much for watching. Take care of yourselves and I'll see you next time. Bye.